starting just a moment. I want to welcome everyone to today's webinar with special guest Chris Blasi. You guys have probably heard him before, but he's going to give us a great update on what's going on recently. Just quick disclosure, CamaPlan does not endorse or give any investment, tax, or legal advice. We encourage you to work with your accountants, attorneys, or other professionals, advisors, before making any investment choices. This is my contact information. I can help you with any accounts that you want to use from your retirement portfolio, such as IRAs and 401ks, etc. And I would like to introduce Chris to you. And this is a little bit of background. I'm going to go ahead and turn it over to Chris, but why don't you tell us a little bit about yourself, Chris?
Okay, Ryan, thanks for the intro. Some of you may know who are longtime Cama clients. I've been working with Cama for well over a decade. So we have a lot of history, which also makes that interesting is we've looked at the markets that we're involved in over that time. And I'm happy to say that, most of really what we discussed and what we projected has, been coming to pass. So a little bit about Neptune. If we can share screens, I would like to.
Yep, you're good to go, Chris, on the share.
Okay, good.
Share.
All right, so, okay, everyone can see that? So
yes.
Just to also reiterate what Ryan said, I come from we're a precious metals dealer, market maker. We're not investment advisors. And today we're going to be sharing some of our opinions or my opinions about the markets. Do your due diligence, do your research as you make your investment decisions, but hopefully you'll find the information that we provide helpful. So a little bit about us, we're headquartered in Wilmington, Delaware. That's where all our metals are stored. We will be expanding that in the future. We were established in 2002. So we entered and the company was created right at the start of the gold bull market. And now we're close to a 20-year history. So we've been around a while. We've grown nicely during that time. And we have done a lot and worked with a lot with clients at CamaPlan. Again, we're a full service precious metals dealer. We trade and transact in all the traditional bars and coins. But what also separates us is we've developed innovative and some patented precious metals investment assets that are really what we believe very beneficial to the investor. So in the past, we've been quoted in a number of publications going way back to 2003. Some of those are, some widely known ones, such as MarketWatch and Barron's. And we've actually had the opportunity to be on TV with things like TD Ameritrade, CNBC, and some of the other well-known media outlets. Today, we're going to be talking about inflation, right? And, that's kind of all in the news right now. And it's interesting, they talk about it as if it was non-existent for a long time. And then in the official realms, they say it wasn't. But right now, it's becoming quite apparent that it's getting some teeth, it's getting traction, and it's a threat to all of us as investors and just citizens. So, people will have a lot of definitions of inflation, right? And what causes inflation? Money creation. And then they say, well, money creation without velocity. So we're going to talk what it really means in the real world, right? We're going to use the terminology and we're going to recognize it for what it means on your day-to-day life. And inflation is a rise in the purchasing prices for goods and services. Or conversely, it's a depreciation of a currency that you're using to purchase those goods or services. And what it also does is it diminishes your standard of living, right? So if you have a constant income stream and the cost of goods are going up, your cost of living is going to decline. So net, it's a negative. Now, who benefits from inflation, right? One thing is debtors, right? Because if a currency is depreciating, the debtor pays the debts off in a depreciating currency. Okay, so right now, or has been for a while, the biggest debtor in the world is the US government. And this is important. If people think that they are outside and not affected by this, what our government, what our Federal Reserve, what our Treasury does, and its effect on the dollar and prices is the core of the economy and is going to dictate your standard of living. Now, for years, inflation has always been sold as good. A little bit of inflation is good. And there's a real debate whether that is true. And that is not necessarily true. They say basically inflation is good for you, at least in small measures, and it's normal. Well, it isn't necessarily good. There have been times in the US history when there wasn't inflation. And I'm not talking about deflation or disinflation during recessions or depressions, but there were times in like the 1800s to early 1900s before the creation of the Federal Reserve, when we were on a gold standard, when there was no inflation, prices were stable. And if you think about it, that is a good thing, especially say you own a business and your income is going up, it gives you more purchasing power instead of just paying more for the same goods. Inflation also benefits financial asset owners, okay? And you got to look at real returns. In most cases, people go into investments and they feel they're getting a return, but it really lags inflation. So you really got to understand if what you're in is really giving you a return or just lessening the damage from the inflation, basically versus your cost of living. And financial asset owners are really the ones that benefit are kind of favored borrowers. Think of large institutions, think of private equity firms like BlackRock or Blackstone that get borrowing at favored rates, something that retail individuals don't have the benefit of having. So the thing about when we're talking about money is, as opposed to some other investments, it's all about policy, right? Who's managing the money? And policy means your leaders in charge, your government. So as opposed to some other investments where you don't have to, unfortunately, delve and talk about policy, and policy, some that you may like and some you may not like, but let's just be objective and look what's happening, and not for the so-called reasons for doing it, but its effect on us. So what has the Fed and government policy been doing for a long, long time, right? And they've been inflating financial assets, right? Stocks, bonds, housing through mortgages, and the underwriting standards and the availability of money. That's been inflating those financial assets, right? It's basically all been done with debt and more debt. And what has that done, especially in the last 20 years? Well, together, the Fed policy, government policy have been blowing bubbles and what they call serial bubbles, right? So let's just look at the last several, right? We had a bubble that burst in the year 2000, which was kind of a stock market bubble. And to bail that out, they created the housing bubble. And that was bigger than the stock market bubble. And then when that failed in 2008, 2009, instead of letting the economy correct and let debtors get wiped out and institutions that were speculators get wiped out, they were all bailed out. And now we have what is kind of referred to as the everything bubble, right? So a lot of very good analysts like the Jim Rickards of the world will say, now you're talking about the everything bubble is what happens when the governments need to be bailed out, right? So first it was just the stock market and it was the mortgage market. Now it's the governments. So that's what we're dealing with right now, okay? This policy has also been constantly bailing out large and favored owners of financial assets or speculators, right? So when the stock market crashed or when the 2008 financial crisis crashed, financial speculators were bailed out, right? A lot of people remember CMOs and CDOs and the institutions that issued them. Well, they were spared, right? The Fed came in, they were called too big to fail. And for so-called all of our benefits, the Federal Reserve, they printed the money, they bought up all those bad assets and basically spared the speculators, right? But again, this is now just this serial bubble blowing. This is just adding more debt on top of existing debt to prop up the system. That's the world we're in right now. And we have to look at our investments from the perspective at some point that does end or change dramatically, causing lots of repricing. Another thing the Fed has really done is deny real world inflation. Now, they're just talking about inflation now, and it's the, and that's kind of inferring that prior to now it was very subdued or non-existent, which I'll make the case that's completely not true. And it's not true because the ones that give us or tell us what the rate of inflation has been manipulating their statistics for way over a decade. You'll hear something called hedonic adjustments, where they'll throw things out and say, well, housing and food and energy, well, those are too volatile. You can't include them. Now, there's always a kernel of truth to that, but it doesn't mean they're not affecting you and they're not part of inflation. So they'll also do things like adjusting the value of things. So if a product goes up, but they say the product is better than it used to be, they say you're getting more for the money, so there really wasn't inflation in that product, which, this is something that, again, has a kernel of truth to it, but is stretched and manipulated to really temper what the real rates of inflation are. And why do they do that, right? Because they're debtors and they don't want to adjust rates to what they should be, because they need to constantly roll their debt and pay their debt, and they want to do it with ever depreciating dollars. What they have been also doing is fending off deflation in financial assets to avoid a systemic collapse. Most recently, that's what happened in 2008, right? Everything would have deflated. As everything crashed, housing would have collapsed, and the cascading effects from that would have been tremendous. So to avoid that collapse in 2008, 2009, there has been a debt binge spree that is just ever increasing. Now, with the recent events with the coronavirus, it's just accelerated from that point. But make no mistake, before coronavirus, things were not good financially. Behind the scenes, it was not good. The financial crisis of 2008 was never resolved. It was just papered over with debt and more debt and rolling debt. And what have they also been doing with the manipulation of statistics and their hedonic adjustments? They've been suppressing interest rates. So because of these actions and these policies in the real world, and this isn't, I'm not making a statement to, it's not about pointing fingers, but what we see happening, and even the 1%, even some of the most well-known hedge fund managers, who are managing hundreds of billions or tens of billions, are saying we have a system that is completely is breaking, right? The difference between the income groups and the gaps are getting destabilizing. So what's been happening because of these machinations between the Fed and government policy? Well, the 1% is getting progressively more wealthy. The middle class is systematically being basically liquidated and pushed into the lower class. Savers have been punished, which really affects the older folks, and the underclass is basically growing and continues to be subsidized and needs more subsidizing from the government. So the reason we talk about this is all very important on the decisions you're going to make on your investment strategies. So now here we are post-pandemic. We have what they're now saying inflation, and also people are talking about stagflation, right? Now, what does the Fed tell us? The inflation is now so obvious that they basically have to acknowledge it. But of course, they say it's transitory, meaning short term, it'll go away. Now, to be honest, we all know they can't come out and say the inflation genie's out of the bag, we've lost control, because that would mean they would need to step up and do something to curtail it, which means raising interest rates, which they can't do. Again, they're the debtors, government's the debtors, can't raise the interest rates. A couple of things we also have to ask about transitory. Well, how is this transitory period, right? What does that transitory mean? What, 6 months, a year, 2 years, right? So really, it provides no information, right? It's just a stall. It's just to forestall having to deal with inflation by either saying we're not going to deal with it or we're going to deal with it and need to raise rates, okay? Also, even if it's transitory, right, and goes back to the rates of inflation before, which will show that we're really higher than was acknowledged. The huge price increases taking place right now, even if they're followed by short-term leveling off, some of these increases are very detrimental because the rates are so high. I mean, we look at things like lumber, which is now backed off a little bit, but it's higher. Freight rates way up, but higher. Real world, knowing someone who's in the restaurant baking business, talking about their costs up 30+% for ingredients, they can't pass those costs on. And if they do, for those that can pay it, right, that's just taking away from their standard of living. Also, don't get a false sense when you hear a lot of the experts on Wall Street say they agree with the Fed's the Fed's observation. Basically, many of them are just Fed apologists. They're always going to tell you the Fed it should be trusted. But if you really look at the Fed's track record, it's horrendous, right? And it's not because they're not smart, it's because they're just trying to manage your perception of things. So now again, in this post-pandemic world, what's really going on? We're getting extreme price increases across the board. That's fuel. You look at the fuel pump up way higher since last November. Lumber, labor's going up. That's really a product of a lot of policy. Shipping costs are up and not coming down. Raw material prices are up. So we are getting across the board inflation. The annualized CPI and PPI right now, consumer price increases and producer price increases, are recently setting multi-decade and record highs, right? I don't believe it's going to be that easy for that genie to go back in the bottle. I think, we could end up with just stagflation. I don't think the economy is recovering across the board in all markets in this country. Like they said, the so-called V-shaped recovery, but we're getting inflation, which could bring us back to the experience we had in the 1970s, stagflation, which was really a horrendous situation. There's also a breakdown in the global supply chain, right? We see key components, mainly semiconductors. Semiconductors will impact and are impacting every industry. We know anecdotally, Ford Motor Company not able and idling plants, not able to produce cars, certain models because they can't get the semiconductors. And these things are not transitory, right? See, this flies in the face of what the Fed is telling you. Semiconductors, which are basically a critical component on almost most products or many of the key products, they say, the manufacturers, it will take years to bring on capacity, new capacity to meet the demands. So again, that flies in the face to the transitory statements of the Fed. And it can't go without saying that, again, it's nice, it's not a path you like to go down, but we're also getting breakdowns in society. The divergence in the classes between a highly affluent class and a growing underclass is causing destabilization and social instability, and also is ushering in demands of government that are taking us in a direction that is probably not good. People will call it socialistic, right? Less and less free market. So these are all important. And the reason it's important is we're talking about inflation and we're talking about money. And this is the bottom line. When it comes to your life, investing, and every aspect of it, this is the foundation, the money. And you can't have a good, strong, stable form of money when you have the divisions and instabilities and destabilizations that's taking place right now. And also, lastly, we're also experiencing pervasive workforce changes. And that's brought about by this pandemic, right? A lot of the policies that are coming out are now creating a culture that is pushing back and saying, we don't want to participate in the workforce, and we don't, we're not interested. They're looking for a different way to be basically earn an income. And these sorts of outcomes were talked about several years ago, but now they're actually taking place, and it's affecting our markets, and it's contributing to inflation, along with a host of other socially destructive outcomes. So let's talk a couple of takeaways. MOPE means management of perspective economics. If you see, everything is just trying to manage your perspective, right? telling you something's there that really isn't or is not as what it appears. So my point from that is take everything what you see with a grain of salt, do your homework. The mainstream messages coming out are really to manage your perceptions. Our economy is becoming more and more centrally planned and managed, and they're going to do this to the bitter end. Again, we have a debt-based economy where it's out of control. The debt will keep growing. It cannot turn back, and this will continue to the bitter end. And there will be an endpoint, okay? We have a shrinking free market economy. The management or the central planning or the bailing out or the too big to fails are more and more being directed from centrally devised policy. And the true free market is shrinking. And really, it's getting to the smaller and smaller segments of the economy. I mean, to be in all honesty, you know, you look at big retail, you look at every aspect, medical, it's all centrally planned, right? Or it's all managed centrally. The only really, and it's a little bit sarcastic, but really, except for the landscapers, the independent restaurants, and the hair salons, there aren't too many truly free, markets that aren't centrally planned. But even them are all being affected by policy, and that's kind of come about. You'll see from, or we've all experienced with the recent COVID crisis.
Chris, while you're on that note, I also want to encourage everybody that if they have any questions, either put them in the chat box, or there's also a Q&A box that they're able to use as well. So, feel free to put those in, and Chris or I will answer any questions that you guys have at the end when he's done.
Thanks. Yeah, please do. Also, these are not political statements, they're just facts. But when you have an economy that is dependent on debt, has everything is too big to fail, no institution is allowed to fail, you need more and more draconian controls of all aspects of the economy. And that's not just happening in the US. China, of course, is way down that path. Europe is the same way, right? But that's what's needed to keep this economy going. And there are crises that are used as the pretext to continue to add and give more and more control to a centrally planned group. Just think of 9/11 and what came from that. People forget, right? Travel has never been the same since 9/11. New banking rules under the guise of money laundering and rooting out terrorism were put into place, but affected everyone in the world of business. But people forget, and they just get used to it. Then there's the 2008 great financial crisis. That brought in more central control, more Fed control. Everything has been taken away from the free market and bringing us to the place we are now. Climate change is being used for the same thing. I'm not going down the path of what my thoughts are on it, but even legitimate things get used, just like the old mayor of Chicago said, don't let a crisis go to waste. Each crisis, as you know, is used for more and more central control, which for us as free market investors is problematic. COVID, same thing. Policies were put in place, such as telling landlords they can't collect rent, right? Really trampling on the Constitution. Doesn't matter what your point of view is, its controls have been now taken under the guise of public health, which will never be relinquished, okay? What has come out of this? Next thing is, we talked about labor force problems. MMT, modern monetary theory, and its cousin, universal basic income. These were dreams of a very socialistic mindset, which are now coming into play now. We don't have an official UBI, but individuals like a Jim Rickards make a very good case that if you look at all the programs in place, all the different stimulus, the household is really getting a universal basic income. And it's not a secret. People know now that people are refusing or reluctant to come back into the workforce because they can make an equal or greater income not working and staying home under the current programs. Some states are trying to take it away. And I see in Wisconsin, they tried to take it away and now they're being sued. So this is a path we're going on. Again, when you go down that path, that just means more and more debt creation, rolling the debt and growing the debt. And the thing to look for in the not too distant future will be your Fed digital dollars, right? So people looked at cryptocurrencies and talked about the advantages to that. I see Elizabeth Warren is now on board here in the US. The Fed is saying they're talking about it. Let me just share with you from my experience. If the Fed says they're talking about it, that means it's really already been built and will be launched. And just as an FYI, and I remember this distinctly, way back, I did a seminar or a webinar, and I know I did a CamaPlan too, and we talked about the Fed minutes. And what happens when the Federal Reserve has their meetings, their minutes are private until a certain number of years pass, and then they become available to the public. Way back in the early 2000s, the Fed was talking about the time value of money. And that's a way to force people to spend. And what the time value of money is, you create a currency that says, okay, it's worth X today, but if you don't spend it in the next 30 or 90 days, we're going to devalue it. That couldn't be done until you have a digital currency. Just so you know, China is now starting that. They've created the digital yuan, and that's going to be one aspect of it. So the Fed digital dollar is coming our way. It's going to be part of maintaining control. That's my perspective, but do your due diligence. And I think if we see the way things are going, you'll agree. They want total control and see everything you're doing. It'll be sold as a guise to stop tax cheats, stop terrorism, you name it, but the main objective is control the money to the most granular level, including forcing you to be a spender, not a saver and investor. Also, another takeaway, there is a breakdown in the global supply chain right now. That's what's leading to a lot of the inflation because parts aren't available, costs are going up. And we're also seeing basically saber rattling between the supply chain partners, most notably China and the US and Europe. That's a problem. So when you create these very fragile systems, and people forget, when everything became, you don't need to maintain an inventory because we don't want the expense of maintaining an inventory. Well, you learn in the long run, there's a value to having inventory. There's a value to having products made in your own country versus relying on a partner. And what puts us in such a bad position is you can't just spin up and move all those products to be manufactured in the US. Not doable. It would take decades. I mean, just open a factory, just trying to get through all the environmental regulations and laws would be, a yeoman's task. So it's not going to happen. So we're in a precarious, dependent position with this global supply chain model that's been developed. And my last thing is, at least from my perspective, they talk about the new normal, and that's not my words. They talk about in the post-pandemic world, we're in the new normal. From my perspective, it's not going to be normal in the way we remember it to be. So I just want to talk about a few things about the reality when they talk about managing statistics. So consumer price inflation, right? There's a fellow by the name of John Williams has an organization called Shadow Stacks. And what he basically does is he tracks inflation the way the government used to track it before they decided that they needed to control that narrative and that message. And they started introducing their hedonic adjustments and other forms of, we'll call it manipulation for what it is, to suppress what the real rates of inflation were. Realize that has an impact of things on like COLA adjustments for Social Security and the setting of interest rates. So here's John's statistics, right? He's a widely followed, widely known individual. So the red is what the government basically had said the consumer price index is, and the blue is what the real rates of inflation have been based on the formula the government used for decades before it became inconvenient. And as you can see, there's quite a delta in between. Now that goes back to what I said before, when inflation, even though it's in the news now, has really been a problem, right? It's just been denied and statistically, not disclosed. Just so you know, the red things up here, we talked about management of perspectives, no free market, central plan. This is management of perspectives. changing the statistics to give you a perception that things are not as bad as they are. And inflation is not good. So this is the reality. This is what we mean. But now, again, the inflation is just so in your face, so dramatic at one fell swoop that even the Fed has to acknowledge it. And let's just look at some of the other adverse effects that are happening in our economy and are moving away from a free market and is going to affect your investments. Here's a good example. From the coronavirus, what do we have? We have the red line is basically the loans that are 90% or 90 days past due, right? People aren't paying their mortgages. They're not paying loans. And that's because under the guise of the coronavirus that landlords couldn't collect rents and there's been a suspension of payments. So what we also see in the blue line is the foreclosures are way down. Now you may say, well, what's this have to do? Well, it has to do with two things. It kind of has to make you reevaluate being a small landlord, but it's also having an adverse effect on the housing market. So when we talk about this unrelenting housing inflation, because of the normal process of foreclosing on someone who's not paying and allowing them to stay in a property, the housing inventories are drying up. The housing inventories dry up, and therefore the house prices are going up. That's real persistent inflation. And I won't even mention about now the effects, the too big to fail private equity firms like BlackRock and Blackstone, who are becoming the largest landlords or are the largest landlords in the country, buying up tens of thousands of homes way above asking price. Again, unfair competition to the individual. This is just pointing out that we're in a system that is being centrally managed constantly. The free market is disappearing, and that you need to factor these things in when you're picking your investments. We talk about the economy. Do we have a V or an L-shaped economy? You were promised a V-shaped recovery. It's really not happening. Here is a good example. This is the amount of people going back to work in major cities like New York and San Francisco. Bottom line is the move back to the old ways of doing things are not happening, and they probably never will happen, and they'll never go back to normal. And this is not something that can just happen in a vacuum. When you look at occupancy rates, commercial occupancy rates in cities like New York and San Francisco and Chicago and Philadelphia, and you name it, at 28%, maybe it'll grow to 30 or 40. What will that do to those economies? What will that do to the mortgage holders of those buildings? The cascading effect of that is dramatic. It's going to require more debt creation, more bailing out, more devaluation of the dollar. That's why these things are important. They're not in a vacuum. They're all interlinked. Again, here's another one-off the Federal Reserve will say. Vehicle prices are going way up because a lot of the availability of new vehicles are way down. That's part of the component problem. So used vehicle prices are going way up. This is putting lots of pressure on individuals. They'll have less money to spend on other goods and services because the cost of buying or maintaining their used vehicles, which is pretty much all that's left, is going up. That's bad for the economy. It'll require a centrally managed economy to create more debt, issue more money, issue more stimulus. The process can't stop. If it stops, the whole thing comes falling down. Again, we talked about some of the perverse effects of stimulus payments and policies that encouraged or dissuaded or disincentivized people from going back to work. So as this nascent economy starts to reopen, you can't have a V-shaped recovery when the job vacancies are going up and people are reluctant or refuse to go back in because you made it too convenient not to, right? These are problems. This affects the economy. It's going to create more debt creation, and it's going to create more devaluation of the US dollar. We all know about the stories about the labor shortages, you know, the firms like McDonald's having to give sign-on bonuses, and still the folks don't show up. So these are persistent problems. Just so you know, it is not the pandemic. So if they say, well, you know, this debt is just being created because we had to respond to the emergency of the pandemic, as I stated before, that problem started before. It started in earnest during the Great Recession at the start of the Great Financial Crisis in 2008. In my opinion, that was the turning point, right? We always had a debt issue before, right? The government was creating debt and was very socialistic in a lot of ways and was not working within their budget. But following the Great Financial Crisis in 2008, 2009, with all the too big to fails, with the refusal to go through the pain at that time and try to paper over those failures, we started on this path that is now the no turning back point. It means ever increasing, ever rolling over of more and more debt. And because of the debt is so gigantic, right? The US government is at $28 trillion in debt right now. And we're not even talking about long-term liabilities that the government has. They can't let interest rates rise. That's why they'll continue to deny that there's inflation, because they can't raise the interest rates, because when you have the volume of debt that they have, and they will continue to have, no matter how low the rates are, it's still painful, but they cannot withstand interest rates moving up to 3%, 4%, 5%. So this is the spiral we're on right now. And again, we're coming around. What does that mean to an investor? Oh, and as far as the Fed goes, as of this morning, gold went down last week, right? And why did gold go down last week? Well, the central bank came out and said that maybe they'll raise interest rates a little bit sooner than they thought. And what they meant by that was 2 years out. They're talking about 2 years from now, 2013. Of course, the markets reacted negatively. Of course, gold pulled back. But at the end of the day, 1 week later, they're already walking that back. So the only ammo to combat inflation would be changes of policy, which is not going to happen, and raising interest rates, which we showed can't happen. So the Fed has no ammo. It's just talk now, right? That's it. So my point is, as an investor, don't follow the talk. Look at the track we're on. Establish the position you believe is right for where we're going, and just stick to it. Don't listen to the week-to-week, day-by-day noise, because that's all it is. It's noise. So we're in a perpetual death spiral. This constantly debt creation. It's going to continue to devalue the dollar. Invest accordingly. The Fed and the central planners are not your allies, right? Their policies are not to bail out you, the individual, or to take care of you. You need to, think independently and different. Eventually, the assets that have benefited from the compounding debt and the creation of more and more debt and the manipulation of the statistics will violently reprice. They call it the reset or build back better. It's coming. It's now publicly acknowledged. These are terms that were only used in what we'll call the alternate financial media several years ago, but now it's kind of becoming mainstreamed. Realize that the global reserve status of the US dollar is diminishing, and it will continue to diminish. Make no mistake about that. And it's time to truly seek safe haven assets. These are ones that aren't supported and promoted and dependent and propped up by the central planning and the debt creation, right? And there's very few of them. And there will be a newfound appreciation and hefty premiums paid for assets without counterparty risk. Now, example, in 2008, that collapse was in assets that had counterparty risk, mortgage-backed securities, you name it. That had to be bailed out. At some point, when the dollars to bail them out just devalue, become pretty close to worthless, and there's this kind of reset, all the things that relied on that and those assets with counterparty risk are going to suffer dramatic loss. So, as you know, we're going to just talk about what are one of the few assets that don't have counterparty risk. I put this up here. This was originally published in March of 2019 at an earlier webinar. So when I say originally published, it means previous webinars. Back then, even Bloomberg was acknowledging the central banks of the world, right? The ones that create the money and basically are controlling the economies through their actions of interest rate setting and money creation. They were buying gold, had been buying for years. And Bloomberg talked about they were on the biggest buying spree. Just so you know, since 2019, that hasn't stopped, especially with countries like China and Russia. So my point is, do what the guys who are managing the economy and really have a seat at the table are doing. Don't go by the day-by-day noise or listening to financial commentators that are really speaking on behalf of a certain industry, such as Wall Street or the banks. Here's another, when you're making your decisions on what assets that might make sense for you. Remember, we talked about management of perspective. If I ask 99% of people out there, if you went into one asset 20 years ago, what should you have gone into, gold or the stock market? Every one of those 99%, that's what, or 99% would say, well, of course, the stock market. That's what we've been programmed to believe. FYI, since if you just bought gold 20 years ago and just bought the Dow, and it's no different for the S&P, gold is up as of yesterday, 577%, the Dow 212%, okay? Case closed. That's management of perspectives. The financial media is constantly telling you gold's volatile, which it is, but all assets are to some degree. But at the end of the day, gold knew the path we were on, and I can attest to it. And anyone who has been on Cama webinars for the 10 years I've been here, we've talked about this. It's just that the coronavirus, which wasn't here 10 years ago and 5 years ago, is just another problem, another thing to be bailed out, another excuse for the perpetuation of the debt creation machine. Now, all because gold is up as much as it is still the asset without counterparty risk, and it's still poised and positioned to benefit greatly in the years to come with the path we're on. And here's a couple reasons why. Why are the precious metals unique? And why are they especially suited for these times? Liquidity. Clients of ours know they can buy or sell at any time, right? So precious metals are liquid. You know, other assets are, stocks are, but real estate isn't, right? People will try to say, well, real estate's a hard asset. Real estate is a hard asset, it's true, but it has so many differences than precious metals and so many risks, especially in these times, especially with things like this, liquidity, portability, and divisibility, that's why you really need to consider the precious metals as a core important component of your portfolio. Portability, it's not reliant on a certain area. You can move the metals anywhere. Divisible, you could buy $100,000, $1 million of precious metals, but as opposed to $100 or $1 million piece of real estate, you don't have to sell it all in one fell swoop. You can buy $1 million in gold and sell off a couple ounces at a time. That's very advantageous for investors. It's globally accepted for 5,000 years. Basically, it's money. No matter what they tell you, gold is money. That's why central banks hold it. And that's why central banks continue to add to their positions. Don't be fooled. At the end of the day, physical precious metals, the actual owning the actual metal, has no counterparty risk. We talked about, or I said, you're going to really appreciate counterparty risk in the future. And what counterparty risk is, that's the likelihood that someone involved in a transaction or in an arrangement is not going to live up to their obligations. An example, you lend someone money, they can't or won't pay you back. That's why lending money, that's why debt instruments have counterparty risk. Stocks, you're relying on you so-called own a piece of a company, you're relying on the people that are running that company to be competitive, to be honest, to run the business well. They're your counterparty risk. When you own actual gold, not in derivative form, the actual gold, no one has to perform or do anything for gold to be what it is. That's why it is the ultimate form of money. And just let's talk about balancing your portfolio, right? We're not advocating everything going into precious metals, but we're advocating that it needs to be a part of your portfolio, it's an important component. And if people ask, well, how much? All I'm going to say is it needs to be, in my opinion, at least enough of a position that as it serves as your hedge or your counter to your other assets, that they're at least enough of a position that it's going to materially help you. So with that said, what other assets, how are they on the counterparty risk scale? Well, stocks, ETFs, which are really just a reflection of a basket of stocks, equity mutual funds, as we said, stocks, which are ownership of a company, whether it's a REIT, right? They all have counterparty risk. Bonds, notes, fixed income, yes. Real estate, yes. Mining shares, yes. The reason I bring that up is, why did I segregate mining shares? Well, some people will say, well, I own the precious metals. I bought Newmont Mining. Newmont Mining, nice investment. It's still an operating company. Operating companies have counterparty risk. The only one that doesn't have counterparty risk is the actual physical metals, gold, silver, platinum, and palladium. And just so you know, and especially for folks who've known me for a long time and been through presentations, I pulled out a couple old charts from past. This one was from 2015. In 2015, I talked about gold entered into a secular bull market in 2001-2. What a secular bull market is not cyclical. There's cycles within the secular bull market. It's a long-term bull market punctuated by 3 distinct legs. The first one being a dramatic move up, the second one being a big retracement, approximately 50% of the gains, and then the third leg is where the biggest gains are made. At the time in 2015, we were in leg 2. And we hadn't hit a true 50% retracement. Now, it doesn't have to hit it exactly, but just, this is what I took out. This is what I actually showed in 2015. That at some point, what we were experiencing in that pullback from 2011 in gold until it hit its next base, there was going to be a turn and we would enter a third leg. That was my projection and my forecast based on what I thought was happening in the market. That third leg had not started at that time, but I said my feeling and my research, and I concurred that we were in a secular bull market, was going to run 20 to 25 plus years, and there would be a third leg. Now, fast forward. Here was something that I published in seminars and webinars in 2020, June 2020. Let's just go back a second. This was June 2015. Gold was at roughly 1,500 or like 1,200 and change. And the 50% retracement mark was at 1,060 an ounce. Last year, 5 years after that, we look back. Yes, actually, this is such a textbook secular bull market. Gold bottomed in December of 2015 at roughly 1,060 an ounce, which was almost exactly a 50% retracement. Just so you know, this orange vertical line is where we were in 2015 at that previous slide. So gold continued to go down for a short period of time, another basically 6 months, hit bottom and has been rising ever since. Last June, gold was at 1,500 and change per ounce, roughly 1,550. And even though there's been volatility in gold, 1 year later, gold is at just shy of 1,800. So again, it's in that third leg, I strongly believe. On top of that, I just like to use technical analysis to really validate forecasts and projections and direction. So from my position, and I've been preaching or basically forecasting that we've been in a gold secular bull market since the mid 2000s, 2003, 4, and 5, even before we entered the second leg. I believe we're in a textbook one. I believe that it's still advisable, strongly advisable to get into position in the precious metals, gold being we'll use it as the proxy for all. And not only that, we are now in this third leg. We are between the second and third leg. From anyone with a technical analysis background will know we're in a pattern called a cup with handle. And that formation is tremendously bullish, meaning it goes through the handle and just rockets up from there. So if you look at policy, what's happening in the financial world, what's happening in our economy, the machinations of the Fed, policy coming out from our elected officials in government, it's all supporting a breakdown in the dollar, a debt crisis that won't be able to resolve with just the printing of more money and the creation of more debt, and conversely, the ultimate form of money, gold and precious metals. And just for those who are, would say naturally, what about silver? Silver always lags gold, and is more volatile. So if we go back on a long-term chart too, we look at silver coming off its lows way back around $5 an ounce. Again, going up, peaking in 2011 like gold, a longer consolidation period to hitting an interim bottom than gold. But again, lagging gold, also greater than a 50% retracement, because as silver usually does, it is more volatile and outdoes gold on the upside and the downside. But gold is in an earlier stage, but is also in what appears to be the third leg. And for anyone who followed fellows like Jim Rickards, he's always said precious metals, it's an essential part of all portfolios. He also talks about diversification amongst the precious metals, which just means a position in more than just gold or silver. And for those who know Neptune Global, we actually make that way of investing very easy and turnkey in something we have a patent on called the PMC Ounce. And I bring that up because CamaPlan, it's approved for IRAs, and CamaPlan is an approved IRA custodian administrator for the precious metals we trade in, but also for the PMC Ounce and the gold and silver vault accounts, which we make available. And just as an FYI, as of yesterday, since 2008, just to see what diversification in the precious metals has been doing, this chart shows the PMC Ounce with a return since 2008 of 179% versus silver at 151 and gold at 110. So as you can see, the metals are all doing well, but this logically diversified product does offer some benefit. Now realize the PMC Ounce is designed to give a better risk-adjusted return. It's not about outperforming, but I'm not going to talk about it. If you'd like to learn more about it or just gold and silver investing, we have specialists, bullion advisors, and specialists who would be happy to answer your questions and work with you. So I'd like to just open the floor up if we have any questions. There were a couple that were provided ahead of time that if no one, if we don't get too many submissions, I will just start to answer and address those.
Go ahead, Chris, and start with those. I didn't see any come through yet.
Okay. All right, as expected, someone said silver. What are your feelings on silver? Well, as stated, silver has tremendous upside potential. Silver is basically, gold is a monetary metal. Silver is the quasi-monetary and industrial metal. So, and the industries that silver is used in are all high growth industries, mostly electronics. Also some of these green programs, these green initiatives, which are basically being dictated to have to take effect by governments of the world. Well, that uses a lot of silver in things like solar panels and such. Also, there's things called green hydrogen, which will consume a lot of platinum, which gives, a good future for platinum. So silver is more volatile. Silver has tremendous upside. Silver kind of lags gold, but we believe, or I believe, that it's like the chart shows, it's at an opportune time to be accumulating it. So I'm bullish on silver. Gold is the primary precious metal, but if one has enough resources that they can take meaningful positions in both gold and silver, that's great. And of course, the PMC Ounce gives you a position gold, silver, platinum, and palladium. Another question we had is, we get this all the time, confiscation, gold confiscation. All right, that is, in my opinion, and I've been doing this 20 years or 19 years, that is a red herring that is thrown out by what I consider unscrupulous dealers who are trying to move people into things like numismatic coins and semi-numismatic coins, okay? And the reason I say that is owning actual bullion, gold, silver, platinum, palladium, not in forms that have big premiums because that form, like an old coin, has, value for scarcity or rarity, right? And that's common with numismatic coins. But back to the basics. The US is not on a gold standard, okay? When Roosevelt asked people to turn in their gold, and that's what they did not come door to door knocking, getting it. we were on the gold standard and we were in the depression and they wanted to issue money and create money. They needed gold to do it. Gold puts handcuffs on a government in the creation of money. It forces discipline. The US and the Treasury and the Fed create trillions of dollars. They are not going to have themselves encumbered by having to have gold to back it up. So the whole rationale and the reason for calling in gold in 1932 and 33 does not exist now. I believe it is just a disingenuous tactic taken by dealers trying to push people into high premium numismatic coins, which in all intents and purposes is not investing in bullion. It's investing in rare coins. Now, if you enjoy the rare coins as a collector, that's nice, but that is not gold and silver investing. So my position is not very, very unlikely. The dollar will continue to depreciate. They're not going to strengthen the dollar and put handcuffs on themselves by going to a gold standard. Okay, someone said, what other safe haven assets other than precious metals are not supported, promoted? Okay, that's a good question. First caveat, I am not an expert and I'm not really can speak to that in a very helpful way, but just an example. So Jim Rickards will talk about this, like art. Art is a form that the wealthy use as a store of wealth. Unfortunately, it is a very small market. It's a very nuanced market. There's no divisibility. You have to basically take fine art to auctions and such. So though it serves as a form of wealth, it is not a practical utility form of wealth like gold and silver. It doesn't function as money. It's a way to put money into something, but it lacks a lot of the characteristics that you would get and you would need that gold and silver offer. So when you think of other safe haven assets, you have to think along those lines, right? What is outside of the system? What is something that basically you can move around? You can even take possession of yourself, is, you know, not dependent on debt creation. And an example, real estate. Real estate, you know, has counterparty risk. Real estate is historically a very good asset for people, but times change and not every time or in every market is it good. If you have a piece of real estate and you want to sell it, you're usually dependent on someone who's going to borrow money to buy it. That is kind of dependent on a system that continues to create more debt and issue more debt, right? So you would have to search, do your research, and try to find other assets that have the characteristics like gold and silver. Like I said, art does, but really not practical. But the bad news is the universe of assets that fall in that characterization is very small. Here's a great one. Do cryptocurrencies like Bitcoin have counterparty risk? Okay. And do you think gold and Bitcoin will both go up? Are they both safe haven assets? Wow, this is a huge topic. I love it. I've spoken about it a number of times, and a lot of my positions, I believe, have been borne out. There is a lot of disinformation with cryptocurrency, and you need to take that into account. First thing, remember cryptocurrency was told how you have anonymity. You're out of the system, right? It's yours. They can't track it, trace it, or do anything about it. Well, did we see what happened last week or 2 weeks ago with the Colonial Pipeline? For those who aren't aware, a big pipeline operator, their systems were hijacked. The hackers that took over the systems demanded Bitcoin. They paid them in Bitcoin. 1 week later, the FBI retrieved all the Bitcoin. What does that do? That completely blows up the whole idea that there's anonymity and that you can hide your Bitcoins and take them with you, and the powers that be don't have control. My position has always been, and I think that proves it, if you're transacting exclusively on the internet and a product like Bitcoin and cryptocurrencies only exist in the realm of the internet, you can only move them around on the internet. They know what you're doing. They know what you have. So, well, Bitcoin may retain its value and go up. It is not a slam dunk as it's been touted. And I think if we look at the pricing action in Bitcoin for the last month or so, that no matter how much talk there is talking it up by people like MicroStrategies who borrowed billions to buy more Bitcoin, it is not rising. Now it could just be it could be in a consolidation phase, and more than likely it is, just the way gold went way up and in 2011 consolidated for several years. That could be happening with Bitcoin. So I'm not dismissing it. I'm just saying there was a lot of pie in the sky and people said Bitcoin was going to 1 million when it hit 40,000. I'm just saying be more skeptical, realize it's going to trade. It does have downside. It doesn't have what I believe are some of the floors and protections, like central banks don't own Bitcoin. Sovereign wealth funds, don't own Bitcoin the way they do gold. So yes, it has the potential to go up, but keep in mind a lot of things that people were told about cryptocurrency and Bitcoin are turning out not to be true. So there's some good debates that go on. There was one with Michael Saylor and Frank Giustra about a month ago that's on the internet. Frank Giustra takes a position more akin to mine. If you want to hear that, I would, or you want to hear some two guys who are passionate on both sides of that debate, you might want to listen to it. And I'll dispel one thing, Bitcoin is not the new gold. Okay. Another question, how about insurance products, contracts, specifically fixed income annuities, which track the market but are not invested in them? All right. My point of view, okay. I'm not an expert, right? I'm never going to put myself out. Any product though, whether it's an annuity, you have to look at what the underlying asset is. And if the underlying asset can go down in value, but they say, but it's insured. Okay, insurance is only good and is only as strong as the firm who's the underwriter or making the claim, right? I can guarantee you something, but if I get wiped out because the market forces and the actions are beyond my control and wipes my capital out, who's there to insure it? Okay, so I think a lot of things are sold and they're told, well, it's insured, but who's the insurance company? Well, I'll give you an example. We have to look at cascading effects, right? Remember we talked about office vacancy rates. Who do you think holds the mortgages on most of those big office buildings, those Class A office spaces? A lot of it are pension plans and insurance companies like MetLife. MetLife says they're insuring an annuity, but the commercial real estate market goes down and takes a MetLife with it. What does that do to their ability to insure a return in an annuity? Now, what will probably happen is the Fed will say, well, MetLife is too big to fail, or those mortgages are too big to fail. So the Fed will buy up those mortgages to prop that market up. That'll just further devalue the dollar. And so it may save that annuity, but there may be a point in time where those bailouts no longer work. Now, that's the way you need to look. You need to look at the sequence, right, of what happens as one market fails, who does it affect? So, it'll probably be bailed out, but again, it will be good for gold because it'll be a process of just continuing to devalue the dollar.
But then, Chris, to your point you made before, we're going back to more central control if the government's bailing people out, right?
Mm-hmm. Wait, I'm sorry. Say that again.
I said, but like you're saying, in that situation, if the government's bailing these people out, then we're going back to your point you made about central control, and now the government's getting more control.
Well, that's it. Exactly. I mean, so, if you either let the chips fall and it takes systems down, because now what they're looking at would fall are so big that, again, the argument would be it's too big to fail and no one wants to go through it. So it'll be the more debt creation and the more devaluation of the dollar. Eventually you'll get to the hyperinflationary, blowout, right? Which you'll hear guys like the Peter Schiffs and such say are on its way. It's just a matter of when, not if. Another question came up. I read a lot about the dollar squeeze being in play over the next few months. Yeah, so there's, the dollar is interesting. The dollar is in a little bit of a rally right now, right, which has also kind of tempered the rise in gold. But our sentiment is that, again, over the longer term, that is a long-term devaluation of the dollar. But in any long-term event you have, sometimes you get moves to the upside, right? It gets oversold and then it rises a little. So that's why, like a secular bull market, and it works conversely, a secular bear market, there's a long move up, there's a time when it consolidates, and then it goes up. Well, if you look at the reverse, the dollar goes down, then there's a short period of time when it rallies for different reasons, but the trend is still down. So unless you're a good, unless you're truly trading the foreign exchange market, or you're going to see moves that, as the dollar moves counter to its long-term trend, will benefit. But precious metal is more of an intermediate to long-term position. So my perspective is always going to be focused more on intermediate and longer term versus short term. And squeezes, like the dollar squeeze, is more of a short-term thing. We'll put a little pricing pressure on gold and precious metals. In all honesty, that just means an opportunity to add to a position or to go in at a favorable price.
Awesome. Well, I appreciate this information, and I'm sure our audience does as well. Do you mind giving out your contact information, or do you have a slide with that too, Chris?
Sure. I think I should have one, and that is, let's see. Why is this not forwarding? Oh, there we go. So you could call our main office at 302-256-5080. And we have some great individuals who've been very knowledgeable about the markets, or have been working with Neptune for a long time and know the precious metals and can assist you on any questions. I'd encourage you to visit our website, neptuneglobal.com. You can get see what the market is doing with the metals and learn more about us. And you could also email us at info@neptuneglobal.com to ask any questions if you didn't want to, bring up a question now, and just like to have us answer it separately and directly one-on-one.
Awesome. Well, I appreciate all the info, and we've run out of time there. I think someone did just ask too if your slides would be available, but we'll let them, call or email you, and if you want to make them available, that's, up to you.
Sure. Ask them to just send us an email with any request, and we'll address that.
Okay. Well, appreciate all the information. Thanks for joining us, Chris, and look forward to doing it again.
Thank you very much, Ryan. And everyone, thank you for coming on. I appreciate the opportunity to talk to you.
Great. Thank you, guys. Have a great rest of the day.